Guys, welcome to our Sam Real Estate Show where we tackle real estate questions. I'm Sam. Today, I actually just wanted to flag that there are different marketplaces within real estate. Today on the Urban Property Investor and podcast, which has just popped today, I talk a lot about where to invest. So if you've ever wanted to understand where to invest in real estate, take a gander at that particular podcast today, the Urban Property Investor. One thing I think is really important from today's podcast, one little sneak lesson which I thought I'd share on RSAM, is to design your portfolio to actually be future ready for your retirement. A lot of that actually means understanding where you're going to invest and potentially how you're going to exit the real estate marketplace. One little gotcha I see a lot when it comes to real estate ownership is the gotcha of building a portfolio on how you buy rather than how you necessarily exit into retirement. In the podcast today, I talk a lot about competition marketplaces, which are basically just driven on price. And of course, perhaps down the track, if you are exiting the real estate marketplace and you're in a price-sensitive marketplace, what that will mean is on the day that you take the cow to the market, if it's not fat enough, you're basically potentially going to not make as much money. Now, does that sound confusing? Well, hopefully not. But the reality is we need to think about what we're buying for actually also 20 years from now when we want to exit this thing called real estate. Because though we should buy well, never sell, many of us will actually be selling real estate into the future to pay off debt on other real estate. It's a big common strategy in real estate to, for example, buy 4 properties, keep 2 and use 2 which have gone up to pay off the other 2. And that is a maneuver that is quite often used in real estate to leverage and then use leverage to pay off debt. Very smart way to actually control debt. Rather than paying it down using your wage or the rent, use leverage to control debt. Now, because you use leverage to control debt, quite often that does mean when you get to retirement, you've got too much debt. The only way out of that is to sell some assets to pay off some other assets. And of course, if you don't plan for what that looks like when you're building a portfolio, just potentially you may grab the wrong assets on the way in, making it harder on the way out. Obviously, the perfect world is to buy the best assets on the way in that are also designed and a little bit future-proofed for your exit strategy. And today's podcast on the Urban Property Investor, it does explore that. So I'd challenge you to go over and listen to that. But overall, make sure that you plan for your exit as much as just what you buy today. It is a big conversation, and a lot of people I see getting into a little bit of trouble today in real estate are buying really blunder assets, inferior assets, rundown assets, really capital intensive assets because they look good on today's paper or balance sheet, but actually once you cost them over a 20-year period, big problem looming. And of course, the exit of those assets today in a very sophisticated marketplace, a very knowledge-based marketplace, probably the day you go to sell up those assets is the correction on the outcome of what you're trying to achieve. So little tip, the little gotcha in real estate is plan your exit